What is your current assessment of today's global economy and financial markets? And Lyn, why don't we start off with you?
So I think the way to summarize it is that, the U.S. economy is decelerating. So purchasing managers indices and other leading indicators are rolling over at a time when the Fed is trying to tighten to control inflation. And so that's somewhat of a stagflationary environment. And that's challenging for most risk assets ranging from equities to bonds. It's probably somewhat favorable for gold. We're seeing somewhat different dynamics in emerging markets where a lot of them had pain in last year, where they were already tightening heavily into the inflation, or in other cases they were cracking down on their industries, and some of them have kind of rising credit cycles, it seems. And so I think that the capital flows and the attractiveness in some assets has shifted from some of the winners of the past 2 years to some of the losers of the past 2 years.
All right, great. All right, so basically we have Jay Powell growing a backbone, the guy who's been slammed for the Powell pivot back in at the end of 2018. Now he's actually deciding to, actually deliver the tough medicine the market, the system needs here. All right, so Lyn, let me come to you for this. So you said, you were seeing sort of stagflation going forward. Curious any feedback you have on Danielle's thoughts there, but if that does happen and we have Powell tightening more aggressively or hiking rates more aggressively than the market currently expects going into a stagflationary environment, what does that really mean? What are the repercussions of that? That seems like, as Danielle said, it might very easily tip the economy into recession and could result in a lot of pain for the average American household.
Yeah, part of why asset prices performed so poorly across the board in the 1970s was because you had that inflationary environment which pressured margins and made long-term planning difficult, but then you also had higher rates that put downward pressure on valuations of risk assets compared to those risk-free rates. And given the current position of where the Fed is, right? So with inflation as high as it is, and with the labor market as tight as it is, their clear mandate is to try to tighten at least until something breaks. And so the big question is, where does it break and what breaks? So do credit markets break like they broke in 2018? Does the treasury market go liquid like it did back in say, early 2020? There's things to watch out for what might break eventually and where it breaks. But I think that their clear mandate is to try to tighten until they get something like that, and then they can kind of say, look, it's out of our hands, we have to do what we have to do, because kind of that shadow mandate of financial stability sort of steps in at that point. I think the key thing to look at and be cognizant of is how high debt is relative to GDP compared to the 1970s. So when we go back to the 70s, you had household debt at something like 45% of GDP. Now it's up to like 80%. It's down from the subprime crisis, but it's far higher than it was in the 70s. If you look at federal debt, back then it was under 40% of GDP. Now it's over 120% of GDP. And so the challenge is that going to those positive real rate levels in this environment is a lot harder than the 70s. And so that's one of the reasons I actually go back further to the 1940s to see that the prior inflationary decade, where you had wartime finance, which is in some ways similar to what we had over the past couple of years. This kind of high debt, wartime finance. The only other time federal debt to GDP was as high as it is now is that you had a rather weak, response. You had basically the Fed captured by the Treasury. It's obviously a very different environment back then, a lot of different aspects to consider, but you had basically them holding rates relatively low compared to inflation. And so far, what caught a lot of people off guard was, if you asked people a couple of years ago, if inflation's over 7%, what will the Fed funds rates be, and what will they be doing, quantitative easing or tightening? Not many people would say that they'd still be at zero and doing quantitative easing and talking about raising rates and tightening. So they've been kind of deliberately behind the curve. But now that their mandates have caught up to them and kind of pushed them, they clearly have to tighten. And I think, I'm going to somewhat take the under on the Fed's ability to tighten until something breaks. So I think they are going to tighten, and they are going to, do their best to follow their mandates. But I think that there's a lot of caution to be warranted about how far they're going to be able to get with that tightening, given that the economy is rolling over and given how much debt is in the system relative to the 70s, which we, it's our kind of our most recent thing to compare things to, but there's still so many differences there.
But Lyn,
All right.
let me
Yeah.
ask you a question, Lyn, just to jump in. Sorry, I'm supposed to raise my hand. Let's assume that the Fed can't tighten, or they're in a position where they have to pull back on that strategy, then what happens?
Well, then you get basically a currency devaluation. So and this is not a US only phenomenon, right? So Europe has this issue where they're trying to manage spreads between different countries, right? So Italy, for example, has like 150% debt to GDP, and they're kind of only solvent to the extent that the ECB helps them be solvent, right? So they wouldn't very do well on their own when selling bonds to the private market. And then you have Japan at over, 250% debt to GDP. So it becomes some of a race to the bottom that, emerging markets, because of the way that they're structured, they generally have lower debt to GDP, but the problem is that more of the debt is denominated in currencies they can't control, mainly the dollar and the euro. But they're able to tighten into inflation because they have to and because they have lower debt. So you saw Brazil, for example, go from 2% interest rates to 9% interest rates last year to try to combat inflation because they had to. Whereas developed markets, because they have more stable currencies, but they also have this longer period of low rates, they build up so much debt that they're actually it's challenging for them to raise rates. And so the ones that are unable to raise rates due to the debt, despite inflation, or at least unable to raise them enough to say positive real levels, they're prone to currency devaluation, in my view.
Sort of two questions. One is like when you when you lie awake at night worrying, how bad could it get if things truly reach a breaking point here? And what do you think that would look like? And then secondly, kind of to the point Danielle was talking about with the Joe Manchins of the world's leaning back, I think there are a lot of our viewers that are almost kind of rooting for this system to break because they know it's unsustainable and they kind of feel like we almost need to get to a breaking point where hopefully, once the dust settles, saner thinking will prevail and people will say, well, gosh, maybe we should do things a little bit, more intelligently going forward. Do you guys almost think that a breaking point is needed? And Lyn, maybe I'll push it back to you first, and then we'll go from there.
I think that's ultimately where this train ends. We go through a very unpleasant period before we get to whatever's next. I think that if there's one thing that keeps you up at night over the long run, it's energy supply. And so I think a lot of things are workable as long as there's enough energy. But if you were to say what would trigger the most catastrophic outcomes for the world economy, this decade, it would be acute energy shortages, right? So I think that's probably the number one risk on my radar longer
Right.
term.
And I'm sorry to interrupt, but could you also just address in your answer here the fact that a lot of commodity spaces, but certainly a lot of energy spaces, oil, et cetera, have been relatively starved of capital expenditures in previous years. And so, there's a lot of people that think that even if we have clear sailing going forward, we just may have some supply issues in our future because we haven't invested in enough development and exploration in the past decades. Do you have that worry too, even irrespective of other types of things that might constrain supply, like geopolitical tensions and things like that?
Yeah, I think outside of 6 to 12 month credit cycles and whatever's happening in Europe, things like that, I think that the longer term issue is lack of capex and some of the intentional energy policies. I think if I were to criticize the economics profession, a lot of the models are very demand side driven, and not a lot of economists will tell you at any given time what's happening in energy and copper and nickel capex, for example. I think more attention has to be on what's happening on the supply side. And one of the big differences in my view for the 2020s compared to the 2010s is that overall energy and commodity supply is tighter than it was back then. Before, you had oversupply, and then you had China slow down. So you had this kind of structural oversupply. You also had US shale oil come online and kind of just totally dislocate global energy markets. And I think that at least the growth of that is behind us. And so now I think we're in a more structurally tight environment. And that doesn't mean energy prices can't go down 30% over a 6 month period if you have, say, a recession or something like that. It's not a cyclical call. It's the fact that I think that this decade overall is tighter. And so if you get that out of hand, I think that's the biggest risk. Outside of that, I would watch credit markets. I would also watch just overall GDP, yield curve, and housing. Kind of basically the Fed can't print more supply. They can't print more oil. They can reduce the demand side. And so from the consumer perspective or the voting perspective, it's kind of like, do you want hot inflation or do you want a recession? And that's kind of the challenge if you're a politician in power or if you're at the Fed right now.